Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for January 5th of 2025. Welcome, everybody. Happy New Year. Hope you all had a wonderful holiday season. This is our first chart pack of the new year, and what I want to spend some time doing is kind of highlighting some of the issues that we have in front of us heading into the new year, some of the opportunities, some of the potential headwinds. As I've told you in the last one or two chart packs, that basically the balance of the economic data is actually setting up fairly well for the new year, even though valuations may be a little bit stretched. But let's start off with this chart here, and it just goes back to the beginning of the rate tightening cycle back in March of 22. Obviously, that was a very difficult year for the investment markets. You can see here, however, that U.S. real GDP growth has continued to remain somewhat consistently positive. And so this rhetorical question at the top of this exhibit is, what happened to those lags, the lagged impact? So when we started 22, we knew that interest rate hikes were coming, and because we could see the inflation materializing, and we expected a recession, and that never came. You can see here that we never even had a single negative quarter, let alone two negative quarters. And so we start the new year here on a relatively good note. We don't have December quarter data yet. We won't get the first reading of that for about another three and a half weeks here. But the balance is setting up fairly well heading into the new year. Here we have U.S. real GDP, the historical annual numbers. What I showed you on the last chart was quarterly data. Here's the annual numbers. So more than likely, when we get the December data, we will have grown about 2.7%. That follows 2.9% in 2023. And even as bad a year in the investment markets as 22 was, we still grew the economy 2.5%. And of course, then prior to that, you got the dislocations related to the pandemic. But as we look forward to 2025, we're not expecting as much growth this year, and there's several reasons for that. I mean, we do have some headwinds. The formula for GDP, for economic growth, is basically consumption, investment, net trade, and government spending. And so, we see some of those things just maybe not growing as fast. It doesn't mean that they're going to necessarily be negative. But when I say maybe a headwind to growth, and the fact that the estimate here, this is from iCapital, and I tend to agree with this assessment, going from 2.7 to 2.1, that's not necessarily a bad thing. It just means we're slowing down a little bit. It doesn't mean that we're retrenching necessarily. And as we'll show you here in a second, that there is still a positive probability of recession, but it's really not that high. And here is that probability of recession. You can see here in this area, this represents the U.S. We've got several different, we've got basically China, the European Union, UK, and the U.S. here, and that's settling in around 20%. And you can see that was a little bit higher earlier in the year. That has come down and remains steady. Again, just to highlight the fact that there is a greater than zero probability of a forward recession. It's just not very high, and neither is it across the globe either. Here we have some charts on the consumer, and I'd say we're in relatively good shape. This line here represents the United States. So we have household debt to disposable income. So we see overall debt levels really didn't get challenged too much in the pandemic. They did perk up a little bit, but they continue to come down. Now, oddly enough, we've got Canada, Australia. Those numbers are much higher overall, but U.S. household balance sheets are in pretty good shape. Here we have consumer spending. This represents historical data here. Of course, we've had some really good years. This is a year in which people were Amazoning during the pandemic. There was some carry forward there in 2021. 2022 was softer year, but then we ended 23 3.5%. You can see again the consumer, they have been beneficial to the economy. Consumer spending, overall consumption in a very broad sense accounts for 2/3 to 70% of the economy. And you can see here 2024 expected to be below 23, and then 25 below 24. But again, not negative. We're not expected to head back and have another 22 event, which is basically an unwinding of all of the stimulus here. And when you think about things in terms of percentage growth, having something that looks a little bit slower isn't a bad thing. It still represents positive growth. It's just not growing as fast. So we look at September retail sales by category, and we've shown you some other portions of this type of data. And again, this is more of a quarterly representation, but miscellaneous stores, clothing, health, personal care, food services, and so on and so forth. And where we saw some retrenching, gasoline stations, that just happens to be gasoline prices moving lower. And some of that has to do with and being monthly data happens to be, the fact that we're getting out of the peak driving season. And so gas prices tend to fall off a little bit when they change the blends to the winter blends. And electronics and appliance stores, we had a negative read there. But overall, retail sales fairly strong. Here we have some selected data. I didn't pull out everything that I had at my disposal. This is from Apollo Private Capital here. So you look at dining reservations, that data's been reasonably strong. That's a flat line there. We had most recently a negative print, but on balance, this data has been what I would say reassuring. Here we have TSA checkpoint data, which remember during the pandemic we looked a lot at because we had that kind of activity. But where we are on this red line, it looks like a relatively good year. In fact, I know in October of this year, right after we had the F1 race here, we had the most travelers at the Austin Bergstrom International Airport that we had ever had. I think that was on Monday. I believe it was maybe October 22nd. But that data has trended very well here over the last year. Here's a quick look at revolving consumer credit as a share of disposable income. And again, not getting too caught up in the inflection points related to the pandemic. We have consumer credit, which we know has gone up. But if we look at it from a relative sense and go back all the way to the beginning of the century here, when those ratios were much, much higher. So this is revolving consumer credit as a share of personal income. And so then after the global financial crisis, it went down and then held at that level for the most part for a while. And then we have this other dislocation. And we're at a point now, and it looks like it's beginning to roll over a little bit, and it's still below levels that we saw prior to the pandemic. So the consumer, again, to reinforce this notion that they're in relatively good shape despite some of these little credit things that we see on the margin with delinquencies and whatnot. It's not a particularly stout problem at this juncture. This chart represents kind of a quick look at the contribution of consumption at the personal level to overall economic growth. And you can see the consumer's been very important in this charge and in this ability for us to stay out of recession in a global or in a kind of a macro sense here. Here's the start of interest rates, and you can see that consumption has, on balance, provided meaningful positive contribution to overall economic growth. We talk about mortgages and housing affordability and all of the derivative spending that comes out of housing, and we've spent a lot of time talking about home prices and mortgage applications and things like that. Well, again, we know the interest rate basket is higher. We know that interest rates are likely higher for longer. But what we have here is a very interesting dynamic in the sense that rates went up so quickly that most people have an effective rate on their mortgage that's maybe right around 4%. And even though the 30-year conventional mortgage rate has kind of peaked up close to 8, and now it's sitting anywhere in kind of a 6.5% range to maybe 7%, with the 10-year Treasury yields having moved higher. But even still, with all these higher mortgage rates, it's a headwind for new home buyers or people that are having to transition and get and apply for a new mortgage. But most of the people out there still have, on average, a very low interest rate on their mortgage. Let's spend a few minutes on construction, manufacturing. When we talk about the fact that we were able to avoid recession, really, I'd say that I'd caveat that by saying manufacturing really did have a recession. And a lot of the pundits, Liz Ann Saunders and others, kind of termed it as a rolling recession that never really handed off to the service sector. But manufacturing clearly had a downturn. But what's very interesting here is that we got a lot of fiscal stimulus at roughly the same time that the Fed started hiking interest rates. And what we see in this chart is a very deliberate uptick in overall construction spending on manufacturing. We'll see in a moment why, or what's been the wind behind the sails of this increase here. And again, you go back to roughly the beginning of this century here, and it's a fairly lazy linear line of best fit here of increase, and then all of a sudden this accelerates, despite the fact that the Fed is hiking interest rates, and that has a lot to do with this massive amount of fiscal stimulus. Some of which still has not even been spent yet. Here we have private construction in the kind of the purple here. We've got residential, and so we saw a lot of home building back in 2021 and heading into 22. That kind of ebbed for a while, and then we see a little bit of resurgence in resi construction here. Now, on the non-residential side, we've had this meteoric rise, as we just showed you. That seems to maybe be cresting here a little bit and maybe holding at a higher level. But we see the manufacturing side of overall non-residential, really rocket shipping up here. And that was reflected in that last chart that I showed you. And even that, as it stands right now, might be cresting a little bit. So we may not be getting as much benefit from this type of spending in 2025, but needless to say, it's a tailwind heading into the new year. Now we've got another look at that capital spending side, particularly as it relates to data centers, and we can't have a kind of a kickoff charts of the week without for a new year without talking about the Mag 7. And what's really interesting here is that the capital spending of the Magnificent Seven is now approaching $50 billion a year. And a lot of this is tied to data centers. And here we have, we'll need to add, a hyperscale data center. And this is an assumption that we'll need to add a lot of capacity here. And so that's going to be driving a lot of this capital spending. And so, basically by this estimate here, which is a compilation of some work by McKinsey and some other people, that basically we're going to need to double our capacity in the power grid to help fuel data center expansion. And there's another chart that I didn't show you here, but the U.S., just absolutely corners the market on data center the number of data centers in operation around the world, and we're going to need many, many more, and this capacity is going to have to be added. So as a theme, I'm still very bullish on like infrastructure spending. That's something that Rich Bernstein has talked a lot about, and I really do believe that not only this type of spending on data centers and whatnot, but we're going to have a lot of infrastructure spending that's going to be needed over the coming decade. We'll talk about inflation here. I got a few slides here, but one quick note on the labor market. Again, we going back to 2020 dislocations already noted. The labor market really stabilized here, and even though the unemployment rate has picked up, we're right at about 4%, and I'd say we're very steady in labor right now. And inflation, just as a in a very broad sense, has come down. We've talked a lot about this. It's been a little sticky lately and not falling at the same rate in 2024 that it did in 2023, but we still see room for maybe rents to ease off a little bit, even though it's highly possible that home prices go back up again a little bit. But rents coming off, wages are still sticky, and they're likely to remain sticky. So maybe this inflation target of 2% is, perhaps not fully attainable at the core price level. And we'll talk about core prices in just a second. But that may be absolutely okay. This is just a target, and the economy has obviously shown that it can work just fine with overall inflation above that target. Here we have the headline CPI, and again, the 2% target. We've been coming down with, again, this is 2024, not as much as we came down in 2023 and 2022. We're still above the target. We are trending lower. Again, even if this settles in at something like 2.3, 2.5, that's not necessarily a bad thing. And just think about, I've mentioned this before, that if you're a financial planner that's been around for more than, say, 15 years, you know that you used to always utilize a 3% inflation factor in your planning assessments. And so we got real complacent because headline CPI was very low for a long time, and we got used to that. But if you take this chart back, way back into the past, I mean, that number looked a lot closer to 3 than it did to 2. Now we'll switch gears slightly and look at core personal consumption expenditures, his core PCE, looking at it from several different ways. I'll maybe come back to this by just showing you year-over-year core PCE inflation. Again, we talk about this 2% target, and I do think we're going to get closer to that. So, and even if this is where we end up, that's really a good place to be, honestly. And you can see the multi-year progression. We don't have the final data here for 2024. Obviously, that comes to us at a bit of a lag, but we have the spike in inflation. Inflation came down. In response, we've got a couple of interest rate decreases, and I think this is giving a lot of people comfort in assuming that maybe we're going to have 3 or 4. And I saw one estimate of 5 interest rate cuts this year. I really don't see that. I see maybe a couple more, and then we're going to spend some time watching data. But this is a good trend, and 2.8, if it really materializes for 2024, represents a dramatic improvement here. And then likewise, 2025 would represent another decrease. And you can see that, from several different metrics. Like if you look at it year over year, which is what this data is, or you look at it on a 6-month annualized change, or a 3-month annualized change, or even a 1-month annualized change, we had a little bit of a uptick in a couple of the recent prints. And so, but if you, again, this number can be a lot more noisy than certainly year over year or 6-month annualized change. And you can see both of those are still kind of trending down. One of the reasons why we're getting some benefit and some relief in inflation is because productivity is moving higher. And this is a chart showing business sector labor productivity output per hour. And you can see that continues to move higher. We've kind of, after a bit of a hiccup for a couple of years, pandemic related, of course, you can see that is reattaining this line of best fit. And so productivity being positive and upward sloping on this chart is one of the reasons. Higher productivity helps to hold down inflation, and this is one of the reasons why inflation is moving in the right direction for us. Another interesting side note, we've got AI. There'll be something that we talked a lot about in 2024, and we're obviously going to continue to talk about that because I do think 2025 is going to be the year in which a lot of these industries that are listed down here are going to begin to actually implement AI, not just talk about it and and markets kind of trade on the hype and not the material implementation. But I think that does happen in 2025, and you can see that in basically all of these categories, whether it goes from information tech, professional services, education, finance, healthcare, manufacturing, construction, in every case, you see expected AI use increasing over the next 6 months. Again, that's going to lead to more capital spending by the Mag 7. It's going to lead to more infrastructure spending across the entire country. I think that sets up well for something that's going to hold up economic growth and maybe provide some downside cover. And what I mean by that is, I think frankly, the more AI that we have, the higher productivity we're going to have, lower inflation, higher spending, and I think it puts a floor underneath the growth rate for the economy, and I think it eventually is going to help lower that probability of recession down much further than where it is starting the new year here. We'll talk about the Fed funds rate. This is very short-term interest rates, and of course, savers have enjoyed much higher rates as of late. We know that was coming down, so 2023 we figured was going to be an aberration, and it was. But again, even 2019 at 1.6, and these numbers are pretty anemic if you go back for several years past 2019. Savers are benefiting here, and we do see rates coming down over time. We see kind of the median Fed projection. This is the dot plot, looking at something that's closer to 3.5. Again, that's obviously higher than 1.6. But overall rates are going to be higher for longer, and they're not going to be what we had prior to the pandemic and prior to the rate tightening cycle that we've just had. But I do think that we probably continue to see on the very short end of the yield curve some continued rate reductions, because I do think we're going to get maybe a couple max rate decreases this year, at least from the tea leaves that I'm reading at the beginning of the year. Here we have corporate profits. Again, looking strong. Corporate America, very strong, and this represents a percentage as corporate profits as a percent of overall economic growth. Again, at probably some of the highest points we've ever noted in this, and this particular survey goes back to 1990. Very strong corporate sector. Now we'll talk about, we'll continue to talk about the corporate sector, but we have had a lot of issuance. So corporations, even with higher interest rates, we're issuing more debt. But what we found is that when interest rates moved up, the fact that corporations had, corporate America was generating more profits, which is the chart that we just looked at, that actually net interest payments were going down. So even as we saw, higher interest rates, that just meant that companies that were generating high margins and high profits were investing those profits and earning a rate of return that was well in excess of their cost of funds, which means that their net interest payments are near record lows right now. So again, corporate America is in really good shape. And even though maybe some of the smaller companies don't have that same kind of benefit, but overall, corporate America is in relatively good shape heading into the new year. Here we have bankruptcies. We've got the bankruptcy numbers, which we knew, and we've talked about this, are elevated from where they were, and actually are elevated relative to pre-pandemic levels, although we've got a few kind of false peaks here that where we're kind of in that same ballpark. But what's very interesting, and this has been very consistent, as you can see the delta between these two, over, honestly, the last 2 years is that the high yield credit spreads continue to contract, and they're very, very tight. I mean, historically tight. And a credit spread, just means the difference in yields between a high yield or a bond of lesser credit quality relative to the U.S. Treasury. And when you have tight spreads, that tells you that the market doesn't believe there's really any stress in the market, as bankruptcy increases might suggest. Well, even these are kind of coming down from an interim peak in 2023. So there's not a lot of stress being priced into the market, and certainly from what we're looking at on weekly bankruptcy announcements, that it doesn't appear that we're anywhere close to a recession right now. We got two charts here, really just highlighting the expectation that we're going to have increased mergers and acquisition activity, and that we're going to have a bounce back. And that's good for public equity. It's great for private equity. They've been looking for a better transactions market to be able to realize profits and realize investment returns. But that market's looking a lot healthier. And again, we had a peak year in 2022, and that went down. You can see that that's really below the trend line and below this longer term average here, but that's expected to kind of reverse next year. And over here, we've got the expectation of increased initial public offerings. So again, for the private equity sector, where they've got portfolio companies that they've been trying to find buyers for, or find the ability to IPO, to take them public. I think both of these would suggest that 2025 is going to be a much better year for that. Here's a number that I was alluding to before. So this goes back to construction spending and on data centers, and you can see that that's going through the roof. And this is basically a repeat of the chart that I showed you several charts about, maybe 10 charts ago, that we're approaching $50 billion in combined capital spending, and you can see data centers moving much higher. Now we look across the globe. Here's our global real GDP, and again, looking good. We were 3.6, 3.3 on the global sphere, 22-23, expected to drop slightly to 3.1 and then kind of hang there. You've got Eurozone looking a little bit better. Again, their 2023 economic growth was really anemic. And even though you may not be excited at 1.1%, that looking at this 3-year trend from where Europe came from is actually very encouraging. And I think it does help to support the case for international allocations in your portfolio investments, because this backdrop is setting up pretty well. And again, I don't believe I included like maybe Japan and China. China's GDP is expected to actually fall, but still be positive. But some of these other areas outside the Eurozone expected to be holding their own, if not increasing, with the lone exception of China. Well, heading into the new year, there are several things that we will definitely be keeping our eye on. One is the whole tariff issue, and we've got a history of tariffs going back to 1900, which again, before we had globalization, the U.S. was very trade protectionist. And then we had the often discussed Smoot-Hawley tariffs, which did help send us into the Great Depression. Here's the general agreements on tariffs and trade, or otherwise known as GATT, that came in the post-World War II environment. And then this multi-decade period of globalization, and that has reversed. This is Donald Trump's foray into tariff building, and of course we know that the current, or the soon-to-be outgoing President Biden, maintained, if not strengthened, some of those tariffs. And so this is a representation of maybe what those tariffs look like if they fully get implemented. Again, I'm here to tell you that I think that that this is not going to be as draconian as some of these lines and some of these charts and some of this rhetoric would suggest, I think that a lot of this is being used as negotiating tactics. And again, we'll see if they work. And in some cases, they can go into place, but not necessarily stay, be used as kind of a weapon for getting a better deal out of countries. But I know the new administration is going to take a pretty hard line on this. So we're just going to have to wait and see. The other thing that we're thinking about heading into the new year and into this new administration is the budget deficit. And you can see we've been running some very large budget deficits. And in fact, the pandemic years, both, during and beyond, represented an increase off of where we were in the middle of last decade. And of course, you got to go all the way back to the second half of the Clinton administration and the pre 9/11 era when we last saw budget surpluses. But you can see the average going over basically a 30-year period. We're still below that and expected to expand our budget deficit as we get that data from 2024. But our incoming Treasury Secretary, or likely to be confirmed, is now pushing towards something that's much more baselined at 3, which is, again, that long-term, very close to that long-term average here. So the other thing related to the budget that's worth noting here is that we've got monthly interest payments on that debt with higher interest rates moving higher. Total interest expense on public issues, that we see that continuing to grow. And this is going to, if it's not already become a bit of a drag on overall government spending, which, as I mentioned very early on, is one of the key components of the equation that comprises economic growth. We'll talk about the dollar and then we'll shift into investments. The dollar's been very strong this year, and we see the 200-week, moving average. So dollar continues to move higher on a moving average basis. We've recently seen a bit of a breakout. Of course, a strong dollar is not necessarily the best thing for maybe commodities, because then it becomes more expensive to foreign entities, and also exports with a strong dollar become more expensive to importing countries, and it tends to dampen our net trade balance, which is another one of those important contributors into economic growth. So, we want a strong dollar, but we want it to be consistent. We certainly don't want to see this breakout here. So we'll have to see to what extent that the strong dollar or strengthening dollar is going to have on overall economic growth in the first half of the year. We'll talk about S&P 500. So very clearly in December, we saw a bit of a sell-off. And so I'd like to think that maybe we're a little bit oversold just on a very broad basis, even though some sectors are more oversold than others. The number of S&P 500 members that are below their 200-day moving average, that are above their 200-day moving average is very low. So a lot of companies have sold off. And if you look at like relative strength here, and these are the number of NYSE issues that are above their 200-day moving average, kind of a similar assessment here, and that number is very low. And you can see typically, and again, this is 2023, so it's not a lot of data, but typically when you see that relative strength kind of break down, that you get ensuing bumps in that factor, and I think that's apt to happen again here in the new year. We have value, the value component of the stock market, testing its moving average. Here's a 200-day moving average, and from a technical standpoint, it's really important that we kind of hold this and that we don't continue to drop further. And we maintain a pretty healthy gap over our 200-day moving average as the market continued to move up here over the last, call it the last 9-10 months or so. But again, kind of an important technical point. Again, I think the markets might be a little bit oversold here. This is great for historical perspective. It's republished in some work by Bank of America, but it's data from Bloomberg. So, in most years, the market goes up. We know that. And this goes back to 1970. So you have some notable years. You got the OPEC embargo. You have back here, you've got, uh, the mild recession that we had around the Gulf War. And then you've got the tech bubble, global financial crisis. You've got basically the pandemic here, and then of course we had a uh, negative year not in 2022. But even in those strong years, and this is the education point here, even in those strong years, we've had max intra-year downturns that were relatively meaningful. See all these red dots were these max intra-year downturns. And even look at these strong years, basically before the tech bubble. We had moments where the index was down 10, like 12, and 20% at one point, but still ended the year up over 20%. And I think that's the theme heading into the new year is that, I think, we can, barring calamity, barring a retrenchment, I think there is room for equities to continue to grow, but it's going to have to be more broad than what it's been. But I do think that there is the risk of increased volatility, which, I think it's been hard to kind of see that. But, we had a downturn that was several percentage points here in December. And I think that's important to take stock of, that's all a part of the volatility equation in the pursuit of these overall long-term gains in the market. High yield spreads we've already talked about, near historic lows, very uncanny. Certainly, if you felt like that we were on the eve or on the precipice of recession, that this would be spiking up, but that is not the case. Here we have a chart on the average U.S. family's holdings within the stock market, and that has dramatically changed over the last several years. And it was trending up anyway, but this is where you get into less sophisticated investors when you're talking about U.S. households. Again, you're also talking about 401ks and savings and things like that, but this number has moved dramatically, and I think it's another one of those things that could contribute a little bit more volatility to the stock market as you have emotion-driven trading. Here we have some comments on small caps. I would say, you've got small caps in the blue that tend to be better insulated from a trading standpoint. Smaller caps tend not to have nearly as much overseas revenue as a percent of total revenue as the large businesses do here in the red. So in some sense, from the potential for tariffs, tariff increases and trade wars and things like that, small caps tend to be more insulated there. And another thing that's very interesting here, we've got the Russell 2000, and these are year-over-year growth estimates as we look out from the fourth quarter of 2024, which we're going to start hearing some of those reports here in the coming weeks, and then getting into basically 2025, you're looking at a phenomenal rate of growth in earnings for small caps next year, and I think that helps to lay the foundation for a good year for small caps. This is something that, as I like to say, every good chart maybe has the potential for an offset, and this is something else that I think is certainly worth mentioning here. You've got the percentage of Russell 2000. Again, these are small caps. The percent of small caps with negative earnings continues to rise in the post-pandemic environment. So while earnings are expected to increase by a very large percent, it's still important to recognize that you have a lot of smaller companies that just simply are not profitable. And another comment on small caps here, we've got basically, you look here at the S&P 500 and then the Russell 2, which is small caps that you tend to have more floating rates. So if you assume that rates are going to remain higher for longer, then small caps might, from a balance sheet perspective, might be a little bit more exposed and having to deal with more interest expense. And that might have an impact on their margins because they're having to pay higher interest expense on that debt. But so far, I think the earnings expectations continue to move higher, and that while we need to be cognizant of this, I don't think it destroys the value proposition in that particular sector. And we've got a couple more charts here. Leverage loan default rates, and leverage loans is kind of a part of the high yield sector. And this is very interesting to me, is that we were beginning to really pay attention to this, or we really paid attention to this coming out of 22 and into 23. But as we went through 2024, these default rates actually went down. We found cash flow amongst the small and middle market businesses actually improve. Finally, I'm going to end with this dramatic chart. This goes back over 151 years, and from Visual Capitalists, and I love their stuff here. What it shows you is that, here's break even. So all of the years that are left to this break even represent years in which we had negative returns, whether they be 0 to 10%, 10 to 20%. And you can see that this is a number that we definitely need to remember. But on the positive side, the market goes up a lot more than it goes down. And you can see that this histogram, if you will, of outcomes is much more skewed towards positive returns. And in some years you get really positive returns, which offset the really negative returns. But again, you tend to have much more positive returns. In fact, market tends to go up, maybe 10 to 20% from a annual basis. We have the most observations in that particular category, but average annual return for stocks is right around, call it around 10% here, maybe slightly less, maybe a little bit more if you include dividends. But again, it's just for perspective that, yes, we have the down years. We tend to have more up years, and the up years tend to be stronger in their veracity than years in which the market is down. That's all we have this week. Hope you've enjoyed the chart pack, and hope you have a great start to your year. And we look forward to talking to you very soon. Bye-bye.